Hi everyone and welcome to the Dollars and Sense Podcast. I'm your host Timothy and today we're recording this episode at the MooFest 2025 at the Suntec Convention Centre. One asset class that have gotten more popular in Singapore over the past few years is the Singapore T-bills. This is particularly true when the interest rate environment is high. Currently, however, the T-bills are generating an annual return of just about 2%. Not meaningless, but certainly not high. In this episode, we are exploring another useful tool in the fixed income space, and this is bond ETFs. Our topic for today is beyond T-bills, how bond ETFs can help Singapore investors diversify and earn steady returns. And joining me today is Bertram, Investment Director and Portfolio Manager at Nikko Asset Management Asia Limited. Bertram, welcome to the show.
Hi, Timothy. Good afternoon. Thank you for inviting us.
Bertram, my first question is really about T-bills. In the last few years, it's been quite popular when interest rates have been high.
Yeah.
But in the recent time, I think the interest rates has gotten a lot lower.
Yeah.
In the January issue, I think it was 2%. Or even in the most recent issue, I think it was below 2%.
Correct, yes.
Right? The question I have is that, sure, it's still money,
Yeah.
but it's really not so attractive. So why do you think T-bills are still so popular among investors?
T-bills has been quite popular. It became into the consciousness of everyone when it reached around 4%, right? It was very attractive. Everyone had 10,000 cash, 20,000 cash can buy T-bills. And as interest rates have gone down, because interest rates have been cut, they've gone down to around 1.85% in the last auction. What we're seeing is that people have now recognized T-bills as an asset class. They're giving you good, steady returns. And at the same time, they're all concerned with what's going on in the market. You have risk from global slowdown, from all the tariffs, the impact of these tariffs, geopolitical risk, and people have appreciated that allocation to fixed income, T-bills, is an important part of their investment. And in line with this, bonds have increasingly gaining interest from investors as well.
With a rate of less than 2%, my question is it still meaningful for investors to think about it? Or would there be better alternatives that they should also consider?
1.85 is not meaningful anymore, so you can get up the curve, meaning add duration or add maturities into your investments by buying bond ETFs. So bond ETFs will offer higher yields than T-bills because you're adding in maturity into your investment. Another part is buying corporate bond ETFs, wherein you have additional spread from investing in corporate bonds. So bond ETFs can give you additional yield from the traditional T-bills, which has offered you now 1.85%, probably going lower given the liquidity in the Singapore market.
With T-bills, it's just one way of investing in fixed income, but there are products like bond ETFs as well in the market. Can you explain to us what a bond ETF means?
A bond ETF is a fund. So you buy into a fund that is composed of similar bonds, let's say government bonds. And our ABF government bond ETF is composed of bond issued by the government from 1 year to 50 years. So it's a portfolio of bonds. And a bond ETF is that you can trade at one go. So it trades at the stock exchange. At one go, you have a portfolio of like 50 to 100 bonds. So that's a good thing about bond ETF is that one trade, you get a portfolio of bonds, fully diversified, and at a cheaper cost.
So instead of buying just a single government bond or single T-bills, you buy into a portfolio of many Singapore government bonds across different maturity periods.
Yes, and the thing with that is, bonds are traded over the counter. It's not easily accessible to retail investors. And so bond ETFs gives easy access to retail investors. For example, an HDB bond, you need $250,000 to trade one bond.
Yes.
So for bond ETF, you just need $1,000 or even lower. Then you get a full exposure to a portfolio of bonds.
Right, that's really why bond ETFs allows more retail investors to be able to get exposure to fixed income or some of these Singapore government bonds.
Correct. So it's an asset allocation tool. I mean, for institutional investors, they buy their own bonds directly, but for retail investors, bond ETFs are the easiest way to access bonds.
Right, and one of the bonds that Nikko AM have is the ABF Singapore Bond Index Fund, which has been listed for, I think in Singapore,
20 years now.
20 years since 2005. Correct. Right. Can you explain to us a little bit about what this bond index fund is?
So the ABF Singapore Bond ETF is designed to give exposure to investors in Singapore government bonds. and some quasi-government bonds like your statutory boards like HTB. So this was really designed to give access to retail investors. And so this contains government bonds of Singapore. So every month, the Singapore government auctions bonds, and this gets into our ETFs as well. So we are buying this government bonds in the index. And what it delivers to investors is the performance of these bonds on a steady basis. So you get the coupon of the bonds, and as these bonds matures, you get back the principal for the ETF. But for the ETF investors, you just gain exposure steadily to the bond market. And it's all government bonds,
Singapore-
AAA and government bonds. Yeah.
So basically, it's a good alternative for people who wants to invest in Singapore T-bills,
Yeah.
but want maybe a different alternative, and perhaps one that don't allow them to have to constantly reinvest their
Money.
back. Because when you invest in a T-bill and it matures after 6 months or 1 year, you have to go and apply for
Yes,
the
yes,
next batch of
So this
T-bills
one
as
is
well.
easy to access daily. You can buy it from the
Because
exchange.
the bond ETF will constantly have bonds maturing and then reinvesting it.
Correct,
into
yeah.
it. How does the returns differ from, say, government T-bills?
So when you buy a bond, for example, one single bond, you get steady coupon from the coupon of the bond. So when a bond is being issued, there's a coupon rate there, and that's being given to you periodically. So you get that. Let's say a recent issuance from the government at 2041 gives you around 2.35%.
Okay.
That's the steady coupon. And usually for the ETF, you give that back via dividends.
Right.
And so that's the steady income. For bonds, they also move in terms of prices based on interest rate movements. So when interest rates go up, bonds may go down in terms of price. And that can be also the same for the bond ETF. So interest rates go down, it's going to be positive for the bond ETF. And so we've seen that in the last 1 year. Wherein a year ago, a 10-year Singapore government bond was like 3.3, 3.5. Currently, it's 2.2, right? And so that decline in interest rates is giving investors, and we call it a principal return because the price of the bonds go up.
Right.
And that has delivered like 8 to 10% in the last 1 year for the government bonds.
All right, so there could be a bit of a capital gain or maybe even a capital loss
Yeah.
depending on interest rate movement.
Correct.
Because ultimately the bond ETF is invested into many of these Singapore government bonds,
Yes.
and hence any difference in interest rate movement could affect the underlying price of these bonds.
Yeah, so in the short term, interest rate movements can affect the performance of the bond ETF. But in the long run, essentially it's the average yield of where government bonds are. Currently it's around 2 to 2.5%. And I think in the long term, that's what you'll get from investing in a government bond ETF.
I think with the ABF Singapore Bond Index Fund, it's probably as safe as it comes by because you're basically investing in Singapore government issued bonds. So for those of us who want a bit of a slightly higher return,
Yeah.
then there is also the Nikko Asset investment grade corporate bond ETF. How is it different from the ABF Singapore Bond Index Fund?
So the ABF is government. So in 2018, we designed and launched this fund to give additional yield to investors. And where do you get additional yield? From credit or corporate bonds. So corporate bonds are issued by high quality corporates in Singapore, and even foreign issuers also issue in Singapore dollars. And this provides higher yields compared to a pure government bond. Usually it's 1% or 1.5%, depending on the credit quality of the issuer. And this additional yield or spread is the additional returns that you can get if you hold this bond ETF.
All right, so you get about 1 to 1.5% higher returns in terms of your yield.
In terms of yield, yes. But in terms of mark-to-market returns, because interest rates move up and down, they will differ in terms of performance. This year, for example, government bond ETF has performed better because of the risk of search for high quality has led to government bonds performing better than corporate bonds this year.
Yeah, and so when you talk about the slightly higher return that you get, it typically comes with higher risk. But most of the bond issuers or rather the bonds that is being held by the Nikko SGD investment grade corporate bond ETF are also from very high quality AAA companies. So you got Temasek, HSBC, Singtel, UOB. So you are basically getting a higher return just by taking a slightly higher risk.
Yes, because the
way to
government
think
is
about
your
it?
safer issuer, right? You know you're good for the principal. But with investment grade corporates, we're also more or less sure that you will get your principal back. These borrowers will pay back their bonds, and you get additional spread from buying in this instrument.
For taking the slightly higher risk premium, I
Yes.
guess.
So this ETF is pure investment grade. So we don't buy those low quality, higher default kind of instruments. So it's making sure that's all investment grade bonds in the ETF.
Right. And just also curious, how much dividends do these bond ETFs pay?
Yes. So the bond ETFs, we give dividends twice a year. And usually it's based on the coupons that the bonds are receiving. In the last year, the government bond ETF gave dividends for around 2.3%, while the corporate bond ETF was higher by around 1%, like 3.2, 3.3%. And this is given twice a year, similar to if you hold one bond directly, you'll be getting coupons twice a year.
Right. I guess one difference is that the bond yield or the coupon payment is not going to be fixed in the sense that because you are taking coupon payments from different bonds within the portfolio, as
Yes.
opposed to if you invest into a single bond on your own, then
Yes.
it's a fixed payment.
Yes,
But
correct.
because this is kind of like a portfolio of bonds,
Yes.
so the coupon payments or the dividends would be a little bit different every 6 months.
Yes,
Is that
yes.
a
But
way to
you
see
can
it?
get an indicative level of what the dividends are based on the average yield of the ETF. You can see in the fact sheets of the
Yeah.
ETF, they have average yield of the portfolio, and that can be an indication of where the dividend yields will be.
We all know that when it comes to investing, asset allocation is very important. I just want to ask you, what are some advantages of having your asset allocation in fixed income through investing in a bond ETF?
Yes. So when you have when you do your portfolio allocation, bonds play an important role. One is their lower volatility, meaning when you add into a higher volatility asset class like equity, they would give you sort of like a lower the volatility of your portfolio. And because they're less correlated, they don't move together at the same time. This improves the diversification of your portfolio. Another part is that bonds perform well when there's a risk of sentiment. Like for example, this year, a lot of concerns. Government bonds have performed well. And when interest rates are going down, you can play that as well in your portfolio so that you can earn from the principal return from interest rates going down. And so that's the advantage of putting in bonds. The drawdown of bonds, meaning the losses from bonds, is not as bad or not in double-digit levels as equities. And so in that sense, they do manage the drawdowns of your overall portfolio. In terms of structure of the ETFs, these are cheap allocation products, meaning you can get in and get out at a cheap way because total expense ratio is cheap. There's no front charges that can be quite high when you buy mutual funds. And so it's easier to reallocate your portfolio, rebalance your portfolio using bond ETFs because they're cheaper, easier to access with daily liquidity.
If I want to invest in a bond fund
Yeah.
or buy multiple bonds, it's probably not realistic
Yeah.
because I will not be able to get much diversification
Correct.
if I have to invest $250,000 per
Yes.
bond, right?
Yeah, because one corporate bond is 250,000. You might be buying one bond that you
And
like,
that's in no
but all of a
diversification.
sudden, 5 years down the road, there's a default issue and concern in that bond you bought. So the diversification that bond ETFs provide, especially for corporate bonds, benefit as well.
I know with every investment, there's always going to be some risk involved. So what are some of the things we need to be mindful of when it comes to investing in a bond ETF?
Yeah, so the risk of investing in bond ETFs is similar to risk buying bonds yourselves, right? So you're exposed to interest rate risk. So when interest rates are going up, you can have negative returns, especially when during the period that you're buying, interest rates are moving significantly higher. So a sharp move in interest rates or credit spreads can lead to some negative returns. But in the long run, theoretically, this returns of negative impact from interest rates rising will be offset by coupons. Essentially, that's one of the risks and primary risk of investing in bonds and bond ETFs.
How about the maturity? Because with a bond ETF, unlike a typical bond, your bond ETF will never mature, right? Because it comprises of many different bonds
Yes,
within it.
yes.
Is that a risk that people need to be aware of, or
Yeah,
it's more of a product construct?
So essentially, the construct of the bond ETF, it has like a stable duration. So you're always buying sort of like an 8-year duration or a 10-year bond. It's always like a 10-year bond, right? So when you get in and get out, it's always like an 8-year or a 10-year bond. And so the thing is that bond price movement is the one that you'll get exposed to.
Right.
So essentially all the time, that's a steady duration exposure that you get. Unlike if you buy a 10-year bond, 5 years from now, it's a 5-year bond. 8 years after, it's just a 2-year bond.
Yeah.
It's not as sensitive to interest rate movements because the longer the bond is, the more sensitive it is to interest rate movement.
And whereas for bond ETF, the duration will always be
More or less the
managed
same.
more
yeah.
or less the same.
It depends on the supply in the market.
Right. So I guess for those of you who are thinking of investing in some of these bond ETFs, just note this are some of the differences between investing in an individual bond as well as a bond ETF.
Yeah.
But I think diversification,
Is there,
a
yes.
much lower upfront amount needed. I think those are
Cheap access. Yeah.
those are very reasonable and realistic reasons why a bond ETF makes sense, because you don't want to put all your money into a single bond.
Correct.
I just want to ask you, for anyone who might be thinking about investing in either the ABF Singapore Bond Index Fund or the Nikko AM
Yeah.
investment grade corporate bond ETFs, what are some advice or some thoughts you will share with them?
Yes. So for me, being like most of our assets are in Singapore dollar, we would have a core allocation of Singapore fixed income. It could be T-bills or cash in Singapore dollars or bonds. These are more your safer kind of investments. And the ABF Singapore government bonds is your government bond exposure. This asset is less correlated to equity, so provides diversification. And then when there's more risk off, performs well. So it sort of like covers your higher risk assets. For corporate bonds, it's an additional credit yield or spreads that we've highlighted earlier. So in the long run, it does perform better than government bonds by virtue of the additional spreads. So these two can be part of your credit or bond allocation.
Obviously, interest rate will always have an impact on bond price movement, right? So for those of us, if we have a certain view on whether we think interest rate might go up or go down in the short or mid-term, how might that potentially adjust our decision on whether to invest in bonds or how much bond ETF position to take?
Usually for me, it's more like you have a set asset allocation of how much bonds you should have in your portfolio, right? And if I view that interest rates are going lower, then I would probably have more bonds in my portfolio. If I'm concerned about recession risk or concerns about the future of interest rates or rates are going down, then I would increase my bond allocation. But on the other hand, if interest rates are so low or there's inflation risk, like you remember 2022, then I'll probably reduce my bond allocation because I know that inflation is not good for bonds. Higher interest rates are not good for bonds. So I would play a plus minus on my core allocation on the bond.
So because rates are low and inflation is high, you might worry that the rates might go
Correct.
up and hence market value of the bonds might go down.
Correct,
So that's
yeah.
one way we can think about it
Yes.
as we try to adjust how much of our portfolio do we want to allocate into bonds
Yes.
and fixed income in general. Between investors who want to choose the ABF Singapore Bond Index Fund, your government bonds, as well as the Nikko AM investment grade corporate bond ETF, is it typically about just, hey, you know what, I just want the extra return, so I choose the corporate bond ETF because it gives me a higher return and I still think the risk is pretty tolerable?
That's correct. Most of the investors that we talk to, or even my colleagues, they do use the corporate bond ETF because they want a higher yield. And in the longer term, they know that it will have higher returns.
Right. Thank you, Bertram, for sharing your thoughts with us on the Dollars and Cents podcast. If you are listening or watching this episode, we hope this discussion on bond ETF has been useful for you as an investor. If you like our content, don't forget to follow us by subscribing to us on the Dollars and Cents podcast, whether you're watching this on YouTube, Spotify, or Facebook. Leave us your thoughts on the comment section wherever you're listening or watching this.